Hi everyone, today we'll be going over accounts, October-November 2020, paper 1-1. This is a multiple choice paper which consists of 30 questions, each of 1 mark, and we are also given a time limit of 1 hour. Now without any further delay, let's get started. For the first question, we need to figure out which accounting concept is being applied when calculating depreciation. So we calculate depreciation under two accounting concepts. So the very first one would be the matching concept, which states that business should record expenses alongside revenues earned. So we know that we obviously record revenues in order to figure out the profit, right? And we know that in order to generate those revenues, the company's or business's non-current assets was also used. So in order to show that use of non-current assets, we calculate the depreciation and record it as a non-cash expense in order to figure out the profit. And the second accounting concept would be our prudence concept, which states that the incomes and assets should not be overstated. And whenever we calculate depreciation, we actually deduct its value from the cost of the non-current assets in order to figure out the net book value, so that our non-current assets will not be overstated in the statement of financial position. So in the options, we have to either look for the matching concept or the prudence concept. Okay, and we can see that matching concept is given here, so this would be our correct answer. Now we can move towards question number 2. A company purchased a new delivery vehicle. Which items would appear in the income statement? So whenever we're talking about income statement, all of the recurring expenses only will be recorded there. And recurring expenses are those expenses which will occur time and again, right? So the very first one is the delivery cost of the vehicle. Now, this is not something that will occur time and again, because once the delivery vehicle has been delivered, it does not have to be delivered again, right? So this is the non-recurring expense. So this should not be included in our income statement. Then the second one is insurance for the delivery vehicle. So for insurance, we need to pay our premiums, right? And those premiums are paid for a certain period of time, which means that it has to be repaid again after the completion of the particular period. So this will definitely be categorized as the recurring expense, which should be recorded in the income statement. Then the third one is painting of the company name on the delivery vehicle. So once the name of the company has been painted, it does not have to be painted after a certain amount of period, right? So we can categorize this as a non-recurring expense, which will not be included in our income statement. Then the fourth one we have is the purchase cost of the delivery vehicle, and this is obviously the non-recurring expense, because once we have purchased it, we do not have to pay for it time and again, right? And this is also a capital expenditure which would not appear in the income statement. So the only item that will be appearing in the income statement is item 2, and that is given in option D. This will be our correct answer. Now we can move towards question number 3. A company has two non-current assets. Details are as follows. So X was bought on 1st Jan 2018, and asset Y was also bought on the very same date. We are given the cost, we are given the depreciation method, as well as the residual value. Okay, now we need to figure out the total depreciation charge to be included in our income statement for the year ended 31st December 2019. All right, I'm just going to create a timeline here. This is the year 2018, this is the year 2019. And we know that both assets were bought on 1st January 2018, right? But we are trying to figure out the total depreciation charge in the income statement for the year ended 31st December 2019. So we are trying to figure out the depreciation charge for the second year. Okay. And for asset X, we can see that the cost is 10,000, and the depreciation method used is the straight line method, which means that the depreciation charge for 2018 as well as the depreciation charge for 2019 is going to be the same, right? So let's figure out the depreciation charge for X. We already know that it is to be depreciated using the straight line method, and we are given the useful life, which is 5 years, as well as the residual value. And in this case, our depreciation formula is going to be cost minus residual value divided by the number of useful years. And in this case, we have the cost of 10,000 minus the residual values of 2,000. And we need to divide it by the useful years, which is 5. Now, this gives the depreciation charge for asset X to have the value of 1,600. And this is the depreciation charge per year. So for the year 2019 as well, the depreciation on asset X is going to be 1,600. Now we just need to figure out the depreciation for asset Y. And the cost is 20,000, but we are using the reducing balance method, which means that the depreciation charge for the year 2018 and 2019 will be different, right? Because for reducing balance method, we need to apply the rate, which is given to be 20%, to the net book value rather than the cost. All right, let's figure it out for the year 2018. This is the year of purchase, which means that asset Y has not yet been depreciated, due to which its accumulated depreciation value will remain at 0. So due to that reason, the cost is going to be equal to the net book value, which means that for the first year of purchase, we can actually charge the rate to the cost if we are following reducing balance methods. So that's going to be 20,000, which is the cost, times the rate is given to be 20%. So we can write it down as 0.20. And this gives the depreciation charge for the year 2018 to have the value of 4,000. Now for the year 2019, the previous year's depreciation will act as the accumulated depreciation, right? Which is going to be 4,000. So the net book value is going to be cost, which is 20,000, minus the accumulated depreciation of 4,000 times our rate of 20%. And this gives the depreciation charge for the year 2019 for asset Y to have the value of 3,200. Now we just need to add this depreciation on asset Y to the depreciation value of asset X in order to figure out the total depreciation charge. So that's going to be 1,600 plus 3,200, which results in the total depreciation charge to be 4,800. All right, and this value is given in option A. That will be our correct answer. Now we can move towards question number 4. A business purchased a new machine on 1st January 2020 for 15,000, paying 10,000 by check. Okay, so the purchase price is 15,000, and out of the 15,000, 10,000 is paid by check, which means that we still have 5,000 left to pay. And the balance here refers to the 5,000 that is yet to be paid, was settled by part exchange of an old machine. So what we can say is that the part exchange value or the disposed value here is going to be 5,000. So we can also term it as disposal value. And this old machine had a cost of 12,000 on 1st January 2018 and had been expected to last for 6 years with a residual value of 2,400. As we can see, we're given the cost, the residual value, as well as the expected useful life, which means that the depreciation method would be the straight line method. And it was bought on the date of 1st January 2018 and we disposed it on the date of 1st January 2020. So let's make a timeline. It was purchased on 1st January 2018, which is right here, and it was sold on 1st January 2020, which is right here. So we need to charge depreciation for the 2 years, right? So accumulated depreciation is just going to be the depreciation charge for 2 years. Let's figure it out. We know that we apply the straight line method. We have the cost of 12,000 minus the residual value, which is given to be 2,400, divided by the number of useful life, which is 6 years. Now this gives the depreciation charge for 1 year, but we require it for 2 years, so we can just multiply it by 2. And this gives our accumulated depreciation value to be 3,200. Okay, now let's figure out our net book value of the part exchanged machine. That's going to be cost minus accumulated depreciation, and we have the cost of 12,000. We just figured out our accumulated depreciation to be 3,200. And this gives the net book value to be 8,800. Okay. So we are also told that the straight line method of depreciation is used, which we applied. Now we need to figure out the loss on the disposal of the old machine. So we can see that the disposal value is 5,000 and its actual net book value is 8,800, which means that there was a loss, right? And loss is just the difference of the net book value and the disposed value. In this case, that's 8,800, which is the net book value, minus the disposed value or the part exchange value, which is 5,000. All right, and this gives our loss on disposal to have the value of 3,800. This is given in option C. That will be our correct answer. Now we can move towards question number 5. Which errors will result in a difference between the total of the individual customer account, balance in the sales ledger, and the balance on the sales ledger control account? Okay, so the very first one is an irrecoverable debt has been posted to the debit of a customer's account. So in sales ledger control account, we actually try and figure out our receivables amount, right? And we know that irrecoverable debt is something that will reduce those receivables. But in case of sales ledger, it does not reduces the sales value. It only reduces the amount that we are yet to receive. So this obviously creates a difference, right? Then the second error is that the discount allowed has only been credited to the customer's account. Again, discount allowed should also be recorded in our sales ledger control account because it obviously reduces the balance of our receivables, right? And this error will result in a difference between the total of the individual customer account balance as well as the balance on the sales ledger control account. Then the third one is that the returns by a customer have been omitted from the customer's account. Obviously, this will also create an error because return by a customer is just return inwards, which would reduce the balance receivable, right? So it has already been recorded in the sales ledger control account, but since it has been omitted from the customer's account, this would create a difference in the balance. Okay, so we need to include all three of these errors, which is given in option A. That will be our correct answer. Now we can move towards question number 6. When preparing the financial statements for the year, the following errors were discovered. We are given the draft profit for the year to be 8,050 and we need to figure out the correct profit. So let's start with our draft profit, which is 8,050. Let's have a look at the first error. No provision had been made for accrued wages of 250. So we're talking about wages, which is definitely subtracted in order to figure out the profit. Then we are told that it is accrued wages. So accrued wages just means that these are the wages for this particular year which have not been paid yet. So it definitely needs to be paid, right? And it needs to be added to the wages actually paid. So that gives a positive and a negative, which is also in a negative. So this just means that we need to subtract the value of 250 in order to figure out the correct profit. That's minus 250. Then for the second error, no account had been taken of prepaid rent of 400. This is rent, which is obviously an expense which should be deducted in order to figure out the profit. Then we are talking about prepaid rent. So prepaid rent means that this is an expense of the next period which should not be included in the profit for this year. So we should exclude it. And in order to exclude, we just need to deduct it, right? So that's another negative. And two negatives result in a positive. This just means that we need to add this value of 400 in order to figure out the correct profit. So that's plus 400. Then for the third error, the sales journal was undercast by 300. So if it is undercast, we need to include this value, which is a positive, right? And we're talking about sales value, which is obviously added in order to figure out the profit. So that's two positives, which again result in a positive. And this just means that we need to add this value of 300 in order to figure out the correct profit. So that's plus 300. Which means that our correct profit will be 8,050 minus 250 plus 400 plus 300, which results in 8,500. And this value of 8,500 is given in option B. That will be our correct answer. Now we can move towards question number 7. The following information relates to a company's banking transactions at 31st December. We are given the balance at bank as per the bank statement. And we're given uncleared bankings, unpresented checks, and bank interest received recorded twice by bank in error. Now we just need to figure out the amount that should appear as the bank balance in the statement of financial position at 31st December. Okay, since we are given the balance at bank as per the bank statement, I'm just going to rectify all of these in the bank statement as well. And in our bank statement, always remember that debit side represents all of the outflows from the bank account, whereas credit side represents all of the inflows to the bank account. And we have the balance of 22,650 on the credit side. So that's 22,650. Then we have uncleared bankings amounting to 3,110. So this just means that these are the amounts that have not yet been recorded in our account. This is an inflow, because these are the bankings, right? So we need to add this amount in our inflow section, which will be the credit side. So that's going to be 3,110. Then we have unpresented checks. So these checks, when presented, will be withdrawn, right? Which means that this will deduct the balance in our bank account. So these are definitely an outflow, which should be recorded on the debit side. So that's going to be 6,290. Then we have bank interest received recorded twice by bank in error. And bank interest is being received, which would definitely act as the inflow to our bank account, right? So this 650 should have been credited once, but by mistake it was credited twice. So in order to cancel one out, we just need to record the same amount on the debit side so that one of these cancels with the one of these from the credit side, and our bank interest received will be 650 again. So we just need to record this value of 650 on the debit side. Now let's figure out the total for debit as well as credit side. For the debit side, that's going to be 6,290 plus 650, which results in the value of 6,940. On the credit side, that's 22,650 plus 3,110, which results in the value of 25,760. We can clearly see that the credit side is the heavier side, which means that our balance will be the credit balance. And that is just going to be the difference of the debit and the credit side total. So that's 25,760 minus 6,940, which results in our bank balance to be 18,820. So this is the amount of the bank balance that should be recorded in the statement of financial position. And this amount is given in option A. That will be our correct answer. Let's move to question number 8. John did not keep sales or purchase ledger control accounts. His trial balance did not balance and a suspense account was opened. Then the following errors were discovered. Okay, we just need to figure out the amount of the opening balance on the suspense account. So I'm going to rectify all of these errors in the trial balance first. Let's do that. So this is the debit side. This is the credit side. Okay, for the first error, we have sales of 200, which had been entered as a credit in both a customer's account and the sales account. And remember that sales are always debited, right? So it should have been sales with the value 200 on the debit side, but accidentally it has been entered on a credit side. So that's going to be 200 credit side. So for us to represent 200 debit side, if we record 200 once, then it gets cancelled out with the error made on the credit side. Right? So we need to record the 200 again on the debit side so that it actually represents the amount of sales made, which means that we still need to record 200 plus 200, which is 400 in our sales account, right? And we're talking about trial balance, and in trial balance, sales are always recorded on the credit side, which means that we need to record this 400 on the credit side of our trial balance. So that's going to be 400. Okay, then for the second one, we have purchases of 350 from J. Brown, which had been entered as a credit in E. Brown's account. Okay, so this purchases of 350 has been treated as the purchases itself, but it just has been recorded under the wrong customer's account. And this is an error of commission, which is not represented in the suspense account because the treatment of this transaction has been done correctly, but it has just been mentioned in the wrong account. So we do not need to rectify this error. Then the third one is that machinery repairs of 600 had been entered in the machinery at cost account. Again, this is the same thing because this is an expense, right, which had been treated correctly because it had been entered in the machinery at cost account, which is also an expense account. So this just means that the amount of the transaction has been treated correctly, but just under the wrong heading, which again is an error of commission, which is not represented by our trial balance. So that's going to be not included. Then the fourth one is that there is returns inwards of 450, which have been entered in the sales returns account, but omitted from the customer's account. So when the customer already returns this goods, this just means that customer does not have to pay 450 anymore, right? So the receivables account should be deducted by the amount of 450, which is equivalent to the goods returned. And this has not yet been recorded in the customer's account, which means that we are still expecting the receivables of 450. So we can term it as an overstatement of trade receivables. And in case of overstatement, in order to rectify it, we just need to record it on the opposite side. And since we are talking about trade receivables, it is an asset, which is to be recorded on the debit side of the trial balance. Now, this is an overstatement, so this should be recorded on the opposite side. So that means we need to record this amount of 450 on the credit side. Okay, this concludes all of the errors. Now let's figure out the total. Obviously, the credit side is heavier, so that's going to be 400 plus 450, which results in 850. That is the total for debit side as well, and that is our balancing figure as well. Now remember that this is the rectification of error, but we are trying to figure out the opening balance on the suspense account. And the balancing figure after the rectification is going to represent the same amount of the opening balance, but just on the opposite side, which means that we have figured out the balancing figure on the debit side. So the opening balance is actually going to be 850, but on the credit side. But in our options, we are not given the debit side or the credit side, so we're just looking at the value. That's 850 given in option D. This will be the correct answer. Now we can move towards question number 9. A business valued its inventory at the year end at cost 24,650. This did not take account of the following. Okay, so the very first one is that goods had been invoiced to a customer at 3,000. So this is the invoice value, which means that this is the sales value, right? And included in sales, they should have been treated as goods on sale or return. So goods on sale or return is not to be recorded as sales. This is still to be recorded as an inventory, right? And these have been included in the sales. This should not be the case. We need to record the corresponding cost value to the inventory value. So let's start with the given inventory value of 24,650. Now we need to add its corresponding cost value, and we are given that the business has a markup of 25%, which just means that cost is increased by 25%. That's 1 plus 0.25 in order to get the sales value. And we already have the sales value to be 3,000, right? So that's cost equals to 3,000 divided by 1.25, which results in the value of 2,400. So we need to record this cost of 2,400 in our inventory as it is sold on a sale or return basis. Okay, then for the second one, goods purchased for 6,400 and included in the inventory have been damaged. So the value of damaged goods should always be deducted from the inventory value. So we need to subtract this 6,400 and now have a sales value of 5,700, and we need to include back the sales value in our inventory valuation, which means that we need to add this amount of 5,700. All right, then returns inwards. So returns inwards is basically sales returns, which had been sold for 800, had not been included in the inventory. So this value of 800 is the sales value. So we need to figure out the corresponding cost and then include this in our inventory valuation. Again, cost times 1.25 is the sales, and in this case we have our sales value to be 800. So the corresponding cost value is going to be 800 divided by 1.25, which results in 640, and we need to include this value in our inventory value. So that's plus 640. Now this gives the correct value of inventory to be 24,650 plus 2,400 minus 6,400 plus 5,700 plus 640, which results in 26,990. And this value is given in option B. That will be the correct answer. Now we can move towards question number 10. A business prepaid its rent. What is the effect of this on the current assets and the rent expense at the year end? So for current assets, if it is a prepaid rent, then that just means that we already paid the expenses, but we have not yet received the services for it. So this results in our receivables, which is included in the current asset, which means that our current assets will increase. That's given in option B and C. Then we have rent expense. So when calculating the rent expense at the end of the year, we actually do not include the prepaid rent, which means that we need to deduct the prepaid rent. So that's a negative, which means that it decreases the rent expense, right? And decrease is given in option B. So the correct answer for this question will be B. Now we can move towards question number 11. At 1st April 2019, a business had a provision for doubtful debts of 3,400. An analysis of trade receivables at 31st March 2020 was as follows. So we are given the amount and the provision required. Then, during the year end, an irrecoverable debt of 3,000 had been written off in the customer's account, but no entry made in the income statement. Okay, no entry had been made for the increase or the decrease in the provision for doubtful debts. Then, the income statement for the year ended 31st March 2020 showed a draft profit for the year of 90,000. Now, we just need to figure out the effect on the draft profit for the year of these omissions. So, we omitted to include the increase or decrease in the provision for doubtful debts. So let's figure out the total amount of the provision for doubtful debts for the year ended 31st March 2020. For amount 50,000, the provision is nil. So our provision for doubtful debts is also going to be 0. Then for the amount of 40,000, the provision required is 5%. So that's going to be 40,000 times 5%, which you can write down as 0.05, which results in the value of 2,000. Then we have 1,600 and the provision required is 20%. So that's going to be 1,600 times 20%, which you can write down as 0.20, which results in the value of 320. So the total value of provision for doubtful debts is going to be 0 plus 2000 plus 320, which results in 2320. And this is the closing balance of the provision for doubtful debts. The opening one is 3400. We can clearly see that the value has decreased, right? So the decrease in provision for doubtful debts is going to be the opening balance minus closing balance. That's 3400 minus 2320, which results in the value of 1080. Okay, and let's figure out the correct profit. We start with our error, which is 90,000. Then we need to include this decrement in provision for doubtful debts. And remember that decrement is always an income, which means that we need to add it in order to figure out the profit. So that's going to be plus 1080. Then we're also told that there was an irrecoverable debt of 3000, which had not been included in the income statement. And irrecoverable debt is always an expense which should be deducted in order to figure out the profit. So I'm just going to deduct this 3000. And this gives our correct profit to be 90,000 plus 1080 minus 3000, which results in 88,080. Now, the effect on draft profit for the year of these omissions is that it actually should have been 88,080, but it has been included at the value of 90,000. We can clearly see that it has been overstated, right? And the overstatement amount is just going to be the difference between these two values. So that's 90,000. The error amount minus the 88,080, which is the correct profit. And this gives the value of 1920. So our effect on the draft profit is 1920 overstated, which is given in option C. That will be the correct answer. Now we can move towards question number 12. X and Y were in partnership, sharing profits and losses equally. Z joined the partnership and profit continued to be shared equally between the three partners. Now, goodwill was valued, but no goodwill account was to remain in the books of accounts. Which entries were made to record the goodwill adjustment? Okay, so remember that in a capital account, this is the debit side, this is the credit side, we always record the goodwill at the previous profit sharing ratio for the existing partners, right? On the credit side. So on the credit side, we need to record X and Y, and this actually records the goodwill value, which should be recorded on the debit side. So that's goodwill for X and Y on the credit side. Then for the new partner as well, Z, now we need to divide it on the basis of the new profit sharing ratio, right? And those goodwill values are to be recorded on the debit side. So that will be for X, Y as well as the new partner. And this obviously records our goodwill. So these are the two adjustments to be recorded. And that is given in 4 and 1. And 1 and 4 is given in option B. So that will be our correct answer. Now let's have a look at question number 13. Which are not appropriations of partnership profit? So the first one is interest on capital, which is recorded in the appropriation account. Interest on drawings is also recorded on the appropriation account. Interest on loan from partner is not recorded on the appropriations account. It is actually recorded in our income statement in the finance charges section. Then we have partners drawings, which is also not recorded in the appropriation account. And we are looking for items that are not appropriation. So that is 3 and 4, which is given in option D. That will be our correct answer. Now we can move towards question number 14. L, M, and N were in partnership, sharing profits and losses in the ratio of 3:2:1. The partnership was dissolved on 31st December 2019, and after all assets had been realized and all liabilities paid, the following balances remained in the books of accounts. Okay, we need to figure out how much cash did N receive when the dissolution was complete. Okay, so this just means that we need to prepare the capital account for N. That's debit side, that's credit. And we start with the partner's capital accounts, which is given to be 10,000, and this should always be recorded on the credit side. Then we have current account balances, but for N, we can see that it is in a bracket, which means that this 3,000 is owed to the partnership business by N. So this should be repaid, which will deduct his capital account balance. So this amount of 3,000 should be recorded on the debit side. Okay, then we have cash at bank. That does not fall in our capital account, but we have realization account, and this is a debit balance. So debit balance on a realization account just means that this is a loss on realization, right? So this 9,000 is the total loss, and we now need to figure out the loss for n. That's going to be 9,000. And in our profit sharing ratio, we can see that it is 3:2:1, which means that for n, 1 part out of the 6 parts belongs to him. So that's going to be times 1 by 6, which results in the value of 1,500. And this is a loss. And losses always decrease the capital account balance, which means that this value should be recorded on the debit side. So that's going to be 1,500. And we are trying to figure out the balance or the cash that n will receive when the dissolution was complete. And that will always be represented on the debit side as the balancing figure. So let's figure out the total from the credit side. That will be 10,000. Then the balancing figure is just going to be the difference between these and the total value. So that's 10,000 minus 3,000 minus 1,500, which results in the value of 5,500. And this just represents the cash that n should be receiving when the dissolution is complete. This value is given in option A. That will be the correct answer. Now we can move towards question number 15. We need to figure out which items will be shown in the equity and reserve section of the statement of financial position. So the first one is debentures, and debenture is actually included in the non-current liabilities section. So this is definitely not included in equity and reserves. Then we have finance charges. So finance charges is not included in the statement of financial position at all. This is something that is to be included in our income statement. Then we have retained earnings, which is a reserve. This is a revenue reserve. Then we have share premium, which is again in reserve, but this is our capital reserve. So the correct items are 3 and 4, and that's given in option D. That will be our answer. Now we can move towards question number 16. An investor owns 5% preference shares in H Limited. 1 year, H Limited does not have enough profits to pay the preference dividend. Then the investor expects the profits to improve and thinks the directors will pay the outstanding dividend in the following year. This just means that the investor is our preference shareholder, right? And 1 year he did not get any of the dividends. So he expects that the profit will improve next year, and the company H Limited will provide the dividends for the next year as well as the last year when the dividend was not paid, which just means that the company will pay the cumulative dividend because it is adding the last year's dividend to the current year's dividend as well, right? So the type of preference shares the investor owns is going to be cumulative preference shares because the dividends are being accumulated over the years when the profit is not adequate to pay the dividends. That is given in option A. That will be the correct answer. Now we can move towards question number 17. The following information was taken from the accounting records of a company at 1st January 2020. Okay, we need to figure out the total capital employed. Alright, capital employed is just going to be the equity plus the non-current liabilities. Okay, now we are given assets, accumulated depreciation, trade receivables, which is again an asset, liabilities, asset. Okay, we are not given equity and non-current liabilities at all, which means that we have to use the equation of our statement of financial position. That is non-current assets plus current assets is equal to equity plus non-current liabilities plus current liabilities. And we require the equity plus non-current liabilities, right? And we can figure it out by adding the non-current assets to current assets and subtracting the current liabilities. So we need to do this. Now the very first one we have is the non-current assets, which should be added. So that's 250,000. And we have the accumulated depreciation, which should be subtracted because remember in the statement of financial position, we include our net book value. And in order to figure out the net book value, we just need to subtract our accumulated depreciation from the cost. So that's going to be 250,000 minus 120,000. Then we have trade receivables, which is an asset. So these should be added. Then we have bank overdraft, which is liabilities. So we need to subtract 25,000. Then we have cash and cash equivalents, which is again an asset. So we will be adding this amount of 9,000. Then we have prepaid expenses of 2,000. So we have already paid for these expenses, but we have not yet received the products or the services, which means that these are the receivables, right? And receivables are always assets. So this value of 2,000 should also be added. Then we have inventory, which is again an asset. So let's add this amount of 17,000. Then we have 5% debenture, which is the non-current liabilities, so we can just skip this. Now the total capital employed is going to be 250,000 minus 120,000 plus 42,000 minus 25,000 plus 9,000 plus 2,000 plus 17,000, which results in 175,000. Alright, and this value is given in option D. That will be our correct answer. Now we can move towards question number 18. A trader has a current ratio of 2:1. Which event would cause this ratio to increase? So we're talking about current ratio, and the formula is current assets divided by current liabilities. And we are trying to figure out the increment in this ratio, right? So for the current ratio to increase, either the current assets should increase or the current liabilities should decrease, right? So we're looking for these two conditions. Now for the first option, we are given buying goods for resale on credit. So whenever we buy goods, this obviously increases the inventory, right? And we are purchasing it on credit, which means that we are also increasing our trade payables. So inventory is current assets. So current assets is being increased and the current liabilities is also increasing, but we require our current liabilities to decrease. So the condition does not match here, which means that our option A will be incorrect. Then the second one is that buying new machinery on credit. So new machinery would increase our non-current assets, right? And in the formula, non-current assets is not mentioned, so we can just completely ignore this. And we are purchasing this on credit, which means that again, our payables is being increased. So payables are included in current liabilities, which means that the current liabilities is being increased. Again, that is not the condition we require. We actually require the current liabilities to decrease, which means that option B is also going to be incorrect. Then we have converting an overdraft to a long-term loan. So overdraft is current liabilities, right? So if we convert the overdraft to long-term loan, that just means that we are taking the sum from current liabilities and including it to the non-current liabilities, which would reduce our current liabilities and increase the non-current liabilities. So we're not talking about non-current liabilities here, so we can completely ignore this. But we can see that our current liabilities is being decreased, and that is the condition we require, right? Which means that option C is going to be the correct one. But let's have a look at option D as well. We have our credit customers paying their account. So whenever credit customers pay their account, we receive the cash. And cash is being received, which means that our current assets is going to be increased. But the credit customers paying their account would also reduce our receivables, right? And the reduction in receivables is again represented by current assets, which means that our current assets is also going to decrease. So the increment and decrement is done by the same amount, which means that our current assets is actually unchanged. And this is not something that is required in the condition. We actually require the current assets to increase, which means that our fourth option is also going to be incorrect. So the correct answer for question number 18 is still going to be option C. Now we can move towards question number 19. A company buys and sells all of its inventory on a credit basis. Then the following information is available. We need to figure out which period of credit was taken by customers. Okay, so we are talking about customers' period of credit, which is basically trade receivables turnover. Okay, we just need to figure out trade receivables turnover in days, and the formula is trade receivables divided by sales value times 365 days. We can see that the trade receivables value is 120,000 divided by the sales value is given to be 500,000 times 365, which gives our trade receivables turnover to be 87.6 days. And we can just round it off, so that's going to be 88 days. And 88 days is given in option C. That will be the correct answer. Now we can move towards question number 20. A company purchases a product that costs 120. The company expects to make a gross margin of 1/3. And we need to figure out the company's markup. So markup basically means profit. Okay, and we are told that the gross margin is 1/3, which means that out of the sales value, 1/3 value is going to be profit, whereas the 2/3 value is going to represent the cost. And we are given the cost to be 120, so let's form an equation. Sales and 2/3 of it is cost. So times 2 by 3 is going to be the cost value of 120, which means that our sales value is going to be 120 times 3 by 2, which results in the value of 180. Now we just need to figure out 1/3 of the sales value, which is the profit, which is what we require, right? So profit is just going to be 1/3 of the sales value. That's going to be 1/3 times 180, which results in the value of 60. And this value is given in option B. That will be the correct answer. Now we can move towards question number 21. A business manufactures electric motors. Which cost can be classified as a direct cost? So the very first one is assembly workers' wages. Wages are always related directly to the production of a good, which means that this is a direct cost. So our correct answer is option A. But let's have a look at the remaining options as well. The second one is factory rent, which is a factory overhead and not a direct cost. So this is incorrect. Then we have machine depreciation, which is again a factory overhead. Then we have salesperson's commission, which is our sales expenses to be included in the income statement. So this is definitely not a direct cost. So the correct answer for question number 21 is still going to remain option A. Now we can move towards question number 22. An employee is paid $16 an hour basic pay for working 7 hours a day. Then overtime is paid at the rate of time and a half. Okay, which means that the overtime is going to be the rate, basic rate, which is 16, and a half of it as well. So that's going to be plus 16 by 2. So that's 16 plus 8, which results in our overtime to be 24 per hour. Alright, then a bonus is also paid at the rate of 32 per unit for output in excess of 9 units per day. Then on Monday, the employee worked 10 hours and produced 12 units. We just need to figure out the employee's total pay for Monday. So we start with the basic rate. For 7 hours, we pay 16. So that's going to be 7 times 16. And we can see that the employee worked 10 hours. So for 7 hours, we have already included the basic pay. Now for the remaining 3 hours, we need to include the overtime. And we figured out our overtime rate to be 24 per hour. So that's 3 times 24. Then we are told that the employee produced 12 units. But we are to provide a bonus in excess of 9 units. So that's going to be 12 minus 9, which is 3. So for 3 units, the employee is going to receive the bonus of 32 per unit. That's 3 times 32. Okay, and this gives our employee's total pay for Monday to be 7 times 16 plus 3 times 24 plus 3 times 32, which results in 280. Alright, this value is given in option B. That will be the correct answer. Now we can move towards question number 23. Details of inventory movements for an item are shown. Okay, so we are given the opening balance, the bought quantities, and the sold quantities. Alright, then we need to figure out the value of closing inventory if first in first out method of inventory valuation is used. Alright, we have the opening balance of 400. We again bought 200. So this is in fact in addition to inventory and not the reductions. Then we have sold. So we sell 100 units, which means that our inventory will be reduced by 100. And we're talking about FIFO method, which means that we need to reduce this 100 from the first batch bought, which would be the opening balance. So that's 400 minus 100. Which results in 300. Then we bought 200, which is an addition to our closing inventory. So we can just ignore it for now. Then we again sold 300 units. We are still talking about FIFO method, which means that this 300 should be reduced from the first batch of purchase, which is the opening balance, because we still have 300 units, right? So we just need to subtract 300, which means that now our opening balance is exhausted. So we cannot use this anymore. Then we have our closing inventory of 400. Okay, we just need to figure out its balance. So the closing inventory value is just the value of the goods that we bought which are yet to be sold, which in this case is going to be the goods bought on 2 February and goods bought on 4 August. So the total inventory value for the goods bought on 2 February is 200 times the rate per unit, which is 11. So that gives 2200. And for the date of 4 August, that's the number of units of 200 and the unit value of 12. So that's 200 times 12, which results in 2,400. So the total inventory valuation is 2,200 plus 2,400, which results in 4,600. And this value is given in option B. That will be the correct answer. Now we can move towards question number 24. We need to figure out what are the advantage of absorption costing. So the very first one is conforms to the matching concept. This is absolutely true because in absorption costing, we redistribute the cost of the service departments to the production departments so that the selling price of each goods reflects the actual costs involved, even of the services department, which definitely conforms to the matching concept, right? Then the second one is that it is a recognized method of inventory valuation. This is absolutely true because if it were not a recognized method, then you guys would not be learning this as a part of your syllabus. Then the third one is it is suitable for determining selling price, which is absolutely true. So our correct answer should include 1, 2, and 3, and that is given in option A. That's the right answer. Now we can move towards question number 25. A business calculates its overhead absorption rates on the basis of direct labor hours. For the month of October, the following information is available. So the budgeted overhead expenditure is 15,000, and the directed labor hours it corresponds to is 5,000 hours. Then we have the actual overhead expenditure of 15,800, which corresponds to the direct labor hours worked of 4,000. Okay, so in order to compare, we need to have the same basis as the actual one, and we can see that for actual, the direct labor hours worked is 4,000. So we need to figure out the budgeted overhead expenditure corresponding to 4,000 direct labor hours. Let's use the unitary method. For 5,000 hours, we have the budgeted overhead expenditure of 15,000. For 1 hour, that is going to be 15,000 by 5,000. Then for 4,000 hours, that's going to be 15,000 divided by 5,000 times 4,000. And this gives our budgeted overhead expenditure corresponding to 4,000 hours to be 12,000. Okay, now we can compare it with the actual overhead expenditure, which is 15,800. So clearly, our budgeted overhead is less than the actual overhead. And whenever the budgeted overhead is less than the actual overhead, it results in underabsorption. So this is the case of underabsorption. And we need to figure out the underabsorption amount as well. And that will be the difference between actual overhead and the budgeted overhead, which in this case is 15,800 minus 12,000, which results in 3,800. So the correct answer is going to be 3,800 underabsorbed, which is given in option D. That is the correct answer. Now we can move towards question number 26. How is contribution calculated? So this is very simple. Contribution is just the difference between sales and variable cost. So this is what we are looking for in the options. The first one is sales minus costs of goods sold. That is incorrect. Then we have sales minus fixed cost. That is incorrect as well. We have sales minus variable cost. This is the correct answer. Now we can move towards question number 27. A company has the following budgeted information. We need to figure out the budgeted break-even sales revenue. Okay, so we are talking about BP in revenue, and the formula is fixed costs divided by contribution by sales. So let's figure out the fixed costs first. We have the fixed production cost of 300,000. Then we have the fixed non-production cost of 120,000, which gives the total fixed cost to be 420,000. Let's write it down. Okay, then we need to figure out contribution by sales. And we are given the contribution value of 480,000. Then we have the revenue value, which is the sales value, to be 800,000. And this gives the contribution to sales ratio to be 0.6. So the budgeted break-even sales revenue is going to be 420,000 divided by 0.6, which results in 700,000. And this amount is given in option B. That will be the correct answer. Now we can move towards question number 28. Which statements describes assumptions made when using cost volume profit analysis? So the first one is that costs can be accurately divided into their fixed and variable parts, which is absolutely true. Then the second one is that costs cannot be accurately divided into their fixed and variable parts. So this is automatically incorrect because the first one is correct, right? Then there are multiple products or a varying sales mix. This is incorrect because while using cost volume profit analysis, we assume that there is only a single product. Then the fourth one is that there is a single product, which is true. So the correct statements will be 1 and 4, which is given in option B. That will be the correct answer. Now we can move towards question number 29. The following budgeted information relates to a business that manufactures two products. So we have product X and product Y. Then the budgeted fixed costs for the period are 400,000. The forecasted sales quantity of product X for the period is 25,000. And the business has a target profit of 180,000. Now we need to figure out how many units of product Y must be sold to achieve the target profit for the period. Okay, we are given the selling price and the marginal cost per unit, which means that we can easily figure out the profit per unit for both product X and Y, right? For product X, that's going to be 120 minus 110. That results in 10. For product Y, that's 130 minus 115, that results in 15. Okay, and we need to create an equation in order to figure out the profit. So let's start with these values. So for product X, we are producing 25,000 units, and each unit is going to produce 10 as the profit or contribution. Then for product Y, we need to figure out the number of product, right? So that is the variable Y times 15 per unit. Then we have the fixed cost, which obviously should be subtracted in order to figure out the profit. So that's going to be minus 400,000. And we're told that this gives the profit of 180,000. Now this is a very simple equation. We just need to figure out the value for Y. That's going to be Y times 15 equals to 180,000 minus 25,000 times 10 plus 400,000. So Y is just going to be 180,000 minus 25,000 times 10, so that's 250,000 plus 400,000 divided by 15. And this gives the number of units for product Y to be 22,000. And this value is given in option C. That will be the correct answer. Now we can move towards question number 30. How can budgeting help a business achieve control of its performance? So the first one is by comparing the actual performance with the budgeted performance. This is the correct answer, because whenever we budget, we expect a certain values, right? And in order to refine our budget for the next period, we need to compare it with the actual performance to see the variance. How far is the expected amount from the actual occurrences of those amounts, right? This helps us control our performance of the business. Then let's have a look at the remaining options as well. For the second one, we're told that by comparing the business's performance with its competitors. So this does not involve budgeting at all. We're just comparing our values with that of the competitors. So this just gives an idea about where we stand among the competition, right? This is incorrect. Then the third one is that by comparing the business performance with the industry averages. Again, this does not involve any sort of budgeted values, which means that this would only give us an indicator of where we stand in the industry itself. So this is incorrect. Then the last one is by comparing the current year's performance with its previous year's performance. Again, we're talking about the performance but not the budgeted values. So this does not help control the business's performance from the point of view of budgeting. So this is incorrect as well. Alright, this brings us to the end of this paper. If you found this video useful, make sure you like the video and leave a comment below. And make sure you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.